Hi, I'm Shae Russell, editor at Fat Tail Media, and today I welcome you to our all-star investment panel. Let me introduce you to everybody. We've got Jacqueline Murray from Resource Capital. We have Deb Caudle from Societe Generale. We have Sophie Spartalis from Bank of America, and we have Karina from Acorn Capital. Thank you for joining me today, everyone.
Hi, Shae.
Thank you.
All right. We're going to kick off today because we have an awful lot to cover. So believe it or not, I'm going to start. Our first topic of conversation today is around gold. And it's simply put, gold has been a very hot mineral to discuss this year. So Sophie, I'm going to come to you first. Now, you're well known for your coverage on gold. And there's been some multi-billion-dollar mergers in the past couple of years in the gold mining space. Even Australia this year has had, our own sort of mega merger happen. Do you see increasing mergers in the gold mining space?
We do. I think we will see more M&A in the gold space, both here locally and also globally. The industry thematics are still there. We've got companies who, the production growth flashes the new up. Mine lives are still incredibly short, and we haven't seen meaningful exploration success over the last few years. So I still think the drivers of M&A are certainly there. And there's also the thirst to move to the left-hand side of the cost curve. So from a portfolio improvement perspective, we're always seeing companies talk around wanting to maximize their margins, and they do that through buying better quality mines. I think that, for M&A, you certainly need motivated sellers though, and you don't have many of them at the moment. And you've also got access, the juniors have a lot of access to capital as well. So, things have to ripen up, so to speak, for M&A, I think, but certainly the drivers are still there. And also it'll be done as long as COVID is still around and the limitations are still there. I think M&A will be done on a knowology basis and a closeology basis. And what I mean by that is you already will need to have prior knowledge of those assets, I think, before you go ahead and do the M&A. And they'll need to be basically in your backyard because of the restrictions on travel. I think it's going to be very hard to justify to shareholders spending billions of dollars by doing remote DD. So, there are certainly some limitations for M&A in the very near term, but we have seen it coming through the sector, and I think we'll continue to see it.
Jackie, I'll throw to you on the same subject. Have gold stocks, they've had an incredible run this year and they were looking a little hot back in June and July. Do you think they've had their run, or are they starting to look overvalued from an investment perspective?
Yeah, gold's it's a bit different. It doesn't have the same supply demand fundamentals as other commodities. So, I mean, if you look at, what you typically look at, supply is definitely incentivized at the current prices. So you would expect to see a lot of spend in this area and more production come to market. And at the other end, we have ETFs, investment in physical gold, at all-time highs. So you could look at that and think it's had its run. Contrasting that is that ETFs are still only 10% of the physical gold that central banks hold. So making a call that they won't continue to buy is a big call. From a private equity space, we look at individual investments, and we still do think that there are assets out there that are undervalued within the space, so that there still is capacity to invest in this market. And also, gold is negative correlated to, industrial metals. So it is something that we will have in our fund, and we've had in every fund since inception. We'll have gold investments through the cycles, and it is something we'll continue to see. You do look at investing in gold versus value you see in other commodities though, and so we will sort of temper that with some of the value we're seeing elsewhere in the market.
I'm glad you mentioned the broader industrial metals there. Now, Karina, I'm going to come over to you now. So let's look at the broader metals and mining sector in Australia. Has our mid-tier sector grown too big? Would investors be wise to anticipate consolidation, or can our mid-tier sector afford to get a little bigger?
Well, I think it's you need to start looking at the composition of the Australian gold sector. And what you can see in the last 4 months since sort of the collapse in the economy through COVID, you've seen the bigger gold producers' valuations run hot. You've seen the junior explorers' valuations run hot. But in fact, in the middle there, you've seen a lag in the valuation of those developers who are almost ready to start production or are still just raising their capital to get their mines into production. So I think when you look at that mid-tier, what we would call part of the micro-cap space, outside the top 250 of the ASX, there's definitely value seen there, but the explorers and the major producers, they look a bit stretched at the moment.
All right, I'm glad you mentioned the sort of the collapse in demand, because that brings me neatly to my next question, which is for Deborah. Now, COVID has disrupted the commodity cycle. With the length of the pandemic unclear at the moment, how do you go about funding projects in this environment? You know, what are you looking for, and how do you work with miners, you know, basically to get the stuff out of the ground?
Yeah, absolutely. And, you know, without a doubt, we are dealing with a heightened level of uncertainty. And I think, you know, really it is about, you know, sticking to your knitting and back to basics. So it is, you know, focusing on the projects that are resilient through the cycle. And it's always a fundamental for us, you know, particularly from a debt financier's perspective. We are typically taking a view on something that is, you know, maybe on a 5+ year tenor. So we are looking at it on a long-term fundamentals basis. So looking at low-cost assets that have got intrinsic strategic advantages over others. And that's really where having a bank that's got a strong sector focus, that has, you know, been through the ups and downs of the cycles and has shown that wherewithal, you know, we've continued to support our clients through this phase, whether it's been financing for Gold Road that we did in Western Australia earlier in the year, and really we've just, you know, continued to focus on those fundamentals of what makes a good asset to be able to look through the cycle.
Now, while we're on the subject of COVID, I'm going to come to you, Jackie. You know, Australia has been quite fortunate in the fact that we managed to avoid the worst of the mining shutdowns that are still affecting miners around the world globally. But my question is, how do private equity firms go about investing in miners, not just in Australia, around the world, when we can't leave the country, we might not be able to get into a country, and even then there's no guarantee of a site visit?
Yeah, it's been a big topic throughout the year, and you know, we'll note it. Australia has done very well, and we have managed to do some investments here in almost normal phase of being able to visit, which is fantastic. But for our investments offshore, and look, our business is investing and managing our investments, so it's not an option just to pause and wait for a couple of years. This is what we do. And it's not just due diligence for new investments, we have existing investments where we have ongoing due diligence. For example, I have an investment in a copper project in Botswana, 2,000 people on site when they go into lockdown in the country. And so it's quite a strange situation for us to have a project through construction, through the stage of where most of our investment is being spent, and to not actually get to site. What we've leveraged is a lot of looking to locally based consultants. So we still say we need boots on the ground. They just may not necessarily be, you know, my personal boots. And so we say who is within borders, leveraging those consultants, guiding them, the typical, you know, virtual visits, but they're not nearly as good as the qualitative information you pick up yourself. So for new investments, there is a bias towards projects that we're previously familiar with. So we've done due diligence in the past, and they've come back around, which happens a lot in our market. Projects come back multiple times over before they get to investment grade. And so there's a focus there, and certainly a focus on where we have offices or partners where we can have people we trust go to site. But it's certainly, as mining companies are finding ways to operate, we need to find ways to continue investing in, and we do.
And as you and Deborah have just put it, basically you've still found ways to invest in this sector. Now I'm going to move over to you now, Sophie. Now, nickel was declared the metal of 2020. Now, granted, that was long before 2020 actually came and found us. What I want to know is, I know you've recently just put out a piece on nickel with your work at Bank of America. So does now that 2020 has unfolded, does the supply and demand fundamentals of nickel still stack up, or is that has been disrupted by COVID as well?
No, look, I think that the growth story is forever evolving with nickel. And one thing to know with nickel, it is what we call a MIFT, which means it's a metal important for future technologies. So the nickel market today is oversupplied because we have seen an increase in nickel pig iron production out of Indonesia. But nickel fundamentals could tighten, more rapidly in the coming years, depending on how we go with the demand of electric vehicles. And, if EVs do disappoint, then certainly the nickel market will continue to be oversupplied, but we do expect that demand will start to consume that surplus. And a key metric from that analysis is that a change in the market share of global electric vehicles by just 1% is equivalent to around 20,000 tonnes of nickel demand by 2025. So to put that into perspective, an average global nickel mine produces around 27,000 tonnes of nickel. So you're basically saying each 1% change is equivalent to a new nickel mine coming on. But we are seeing dislocations at the moment to fundamentals, despite this oversupplied market. Nickel has rallied nearly 45% since March this year. So, it is a market that does get heavily influenced by geopolitical factors. And obviously technology is having a huge role in how the whole nickel growth story pans out going forward.
Now, Karina, I would like to move on to the subject of electric vehicles that Sophie has just brought up. Now, in the past couple of years, some private equity firms were reluctant to invest in battery minerals, but I know Acorn Capital bucked the trend and made significant moves into this market. In fact, you yourself in some of your comments have been noted the importance of Elon Musk securing the upstream supply. Now, what I want to know is, what did Elon Musk moving into the upstream supply signal to you? And why is it so critical to be investing in battery minerals and battery metals, especially when we still don't have, the final perfect chemistry of what the battery vehicles are going to look like?
Thanks, Shae. I think that it's important to recognise that the battery technology that cars are going to be using for at least the next 5 years is the old technology, and therefore they will still need the old percentages of battery metals. And we certainly did see that there was a boom in prices for battery metals back in 2016-18. But our view is that that was really about a pull forward of supply for China's internal battery needs. And more recently, we've now seen that the Western world has pivoted very strongly to electric vehicles, whether it's through mandated emission standards in Europe or London, in fact, outright banning internal combustion engines by 2035. In addition, in Australia alone, we've seen multiple states just recently come out and talk about installing battery storage for the purposes of electricity supply. So we've definitely started to see the Western world pivot towards this battery thematic, but prices did collapse last year across most of the commodities, resulting in curtailed supply, and then new supply was put on hold. So you're definitely starting to see, looking forward to 2022 and beyond, that there may very well be a shortage of these products. We have started to see since October that lithium and the rare earth prices are rising, and my view is that the OEMs are worried about another price spike. And are looking at ways to mitigate that going forward, whether it's through investing in upstream supply, which is what Tesla was basically saying at their battery day, or through signing up offtakes to guarantee supply from existing producers, but also those developers that are still in the pipeline who put their projects on hold, result from the drop in prices last year, but are now starting to move their projects forward. So it is there is definitely a supply shortage coming, and the companies themselves, the OEMs, the customers of those products have started to recognise this and are now taking steps to mitigate that going forward.
Thank you for that. Now, Deborah, I'd just like to move on to you on the importance that these metals and minerals are going to play in what I believe Societe Generale has been calling the energy transition coming forward. Can you explain in depth, what those metals and minerals are going to do, and obviously how important it is to secure financing for some of these projects?
Yeah, sure, absolutely. And, I think when it comes to the role of those metals in the energy transition, it's not so much about bankers saying that this is the role that's going that they're going to play. It's actually come from the World Bank. So they released a report, Minerals for Climate Action, and the growing role of minerals and metals for a low carbon future. And they quite clearly set out the role that minerals and metals are going to play in that energy transition. And then likewise, in the EU taxonomy, it was again reflecting on the fact that the energy transition cannot happen without metals. So whether it's aluminium, if it's lithium, nickel, as we've touched on for EV batteries, the role of copper in electric vehicles and renewable power. I think the thing that's been, made quite clear is that the low carbon economy is actually going to be mineral intensive. And so we're going to actually need to meet that growing demand, whether it's through increasing number of mining projects coming online, but then also looking at the circular economy and then the role of recycling as part of that. So for us here at SocGen, when we've been looking at, a lot of these thematics that have been playing out, the scope of our mining and metals team, we actually broadened out into a mining, metals and related industries team. And that's about looking downstream into things like the EV battery facilities, and then also at metals recycling as well. We think they're going to be increasingly important. So this year we've already closed 2 financings for EV battery facilities. And again, looking at that recycling side of things and the role of the circular economy and where metals are actually going to be coming into that. And we think that that's going to become increasingly important. I think it was actually Mark Kudafani who commented last week on just that role of circularity and what it's going to mean for mining and metals companies going forward.
I'm actually just going to hold you for one more question, if you don't mind. Now, you've made obviously the importance of metals and minerals going forward. Now, Societe Generale has actually come up with a couple of new type of loans, both hybrid and green loans, and they both play very specific roles in the market. Can you expand on what SocGen's attempting to achieve here?
Yeah, sure. I think there's been a couple of financing products that have been gaining a lot of traction. So sustainability linked loans and green loans in particular as part of those. And there's and I think if we look at something like the sustainability linked loans market, since 2018, it's grown from a $2.6 billion market in Asia Pacific to so far this year, it's over $10 billion year to date. And so we're seeing a lot of interest from investors in this space, as well as from, banks themselves. And it's something that, we in the Mining, Metals and Industries team have spent time actually trying to spearhead the applicability to the mining industry of these sustainable and green financings. And really working with our clients to link their financing strategy to their ESG strategy. And so whether it's about incentivizing KPIs around performance metrics being incorporated into the financing, and so then clearly articulating to investors how they're going to be delivering on some of their ESG initiatives. And that's what those products are looking at. And it's an area that we think is going to become, more and more important, and we'll see more of these dedicated financings becoming a bit of the new normal.
I'm going to move over to you now, Karina. Now, as Deborah just mentioned, a lot of a lot of investments are starting to look at downstream in the circular economy. Now, I know you've mentioned in the past how Australia is really great at producing a raw product, but we don't really have the downstream capabilities. So what does this lack of downstream capability mean for the mining sector? And is there any value to be found in companies that are investing in these downstream products?
Oh, you're absolutely right. As the world knows, Australia is great, world-class miners, but the problem by not focusing on developing that downstream capability, Australia misses out on the higher price that you receive for those products, the taxes that are associated with that higher price, and also we limit our processing technologies and innovation opportunity, as well as skills development and the employment outcomes that come with that whole supply chain. We have seen that the lithium miners over the last 2 to 3 years have looked at building downstream processing technology. In fact, Tanshe and Albemarle, who own the Greenbushes mine, have actually built their own hydroxide plant in Kwinana in WA. We've seen Lynas look to build part of their processing plant back in Australia. We've seen the nickel miners, the major nickel miners like BHP, IGO and Western Areas, all complete studies on how to produce nickel sulfate from their nickel mines for the purposes of battery manufacturing. So whilst Australia probably can't compete across the complete supply chain, whether it be through the cost of energy or through our labour cost, there are parts of the supply chain where we can add value and extract that value for Australia's purposes. And so the opportunity that I see for Australia is creating a specialist battery hub, if you like, where there is special skills developed, innovation occurs, leading to greater employment opportunity, and then the profits and taxes that can flow from that. But one of the big challenges Australian mining companies have always faced in this space is that inability to source large sums of capital for these complex chemistry plants. But I'd anticipate, given what's happened in the past year, the cost of capital has come down and there is this global strategic focus on diversifying supply, the critical mineral supply. So I think there is every chance that in the next few years you will start to see more and more of this downstream processing plants being built in Australia.
Sophie, I'm going to come to you for a follow-up. Does this mean, is a miner no longer a traditional miner? Are we going to see further increase of miners abandoning their traditional models and investing downstream?
Yeah, look, I think Karina touched on a lot of good points there. I think this question, is a miner still a miner, got a big nudge along at the Tesla Investor Day in September. And, we heard from Elon Musk that he was urging mining CEOs to increase their nickel production to enable the electric mobility transition. Given Tesla is considering mining its own lithium in Nevada, we wonder, are these lines of miner versus battery producer being blurred? Is Tesla really pushing the industry to think twice about the supply chain, particularly for those EV metals? BHP has dabbled and crossed over to nickel sulfate. As Karina said, Western Areas and IGO have also done their studies on nickel sulfate. Does it need to go one step further into the supply chain to stay relevant? And I think these are all really good questions that the mining CEOs certainly will be trying to answer over the next few months, even years, to stay relevant. And I don't think a miner can just be a miner anymore, particularly in this EV space. If we look historically, BHP has certainly shifted the paradigm previously. If we look at iron ore and coal, we went to, from an annual pricing contract to spot pricing. How might BHP change the paradigm for nickel? I think that this will all come through certainly, in the coming years. Tsingshan, that's a Chinese stainless steel producer, along with Nickel Mines, who's the miner. They've done something similar. They've revolutionized the stainless steel industry with the supply of the Class 2 nickel units. I think that what we're really looking at is there room for somebody now to revolutionize the Class 1 nickel unit? So it's a really, I think, important question that all the global mining CEOs need to answer. And I think that those lines are certainly being blurred, and the miner will need to err on sort of moving down that supply chain to stay relevant.
While we're on the subject of battery minerals, I just wanted to touch on lithium quickly with you, Jackie. Now, I believe Resource Capital were one of the first to point out that lithium had formed a bottom. So what actually drew you to this conclusion, and how did you go about investing in it from there for your clients?
Yeah, no, I wouldn't necessarily single us out as the first. There's certainly others investing in this market, and particularly with prices we're seeing over the last couple of months, there's quite a few people that have picked up on the theme. Look, we have been watching lithium very closely and formed a thematic view for most of 2020. And that has culminated in our commitment to invest in Pilbara Minerals for their proposed acquisition of Altura. Look, I think just a reminder that we used to own Greenbushes lithium mine through Talison Lithium prior to the sale to Tianqi. We also have an investment in Global Advanced Metals, which is leveraged to the byproduct tantalum supply from a lot of lithium producers. So it is a market that we keep tabs on a lot, really do watch the supply demand fundamentals, and following the price crash of recent years, looking at the projects and their time to market, and really seeing that there is really a strong move for some incentive pricing to be coming now. So it's looking like it's a good timing, but certainly that is being picked up by the general market, certainly over the last few weeks.
Jackie, I'm just going to stay with you for one more question. Now, I know you're talking about the general market consensus around lithium, but I know in the past that Resource Capital has actually looked at out of favour commodities that the market generally doesn't like. So what would draw your company to assets that are essentially unloved by the broader market?
Yeah, well, I think it's everyone's aim to buy low, sell high. So we're all hoping to pick the unloved commodity that's about to be loved in the near future. Is easier said than done. Look, I think we understand that commodities are cyclical, and understanding that cycle, understanding the speed of the cycle. So by way of an example, for battery metals, the copper market's 10 times the size of the nickel market, which is 10 times the size of the lithium market. So when you have a demand pull, your speed of those cycles in those commodities are going to be quite different. So the dynamics of pricing in those commodities are quite different, even when with a thematic view over the top. So we look at those cycles and we often look at the value. So we're looking at the price of assets compared to our view of where the commodity price can go in a cycle of, what for us could be a 4 to 5 year hold. And you're really looking for signs of an uptick and early signs of that. Not always successful, but we have done well in particular moments in time.
That's the aim. All right, Deborah, I just want to touch back on something you said earlier before, and that is this idea of the circular economy. Now, how important when it comes to the projects you consider and the ones that you take on, how important is the role of the circular economy to your investment strategy?
Sure, I think it's probably an area that we're just starting to evolve into. So the expansion of our mandate to start looking at areas of recycling in the metals markets. We expanded into that a few months ago. So it's something that we're still, building on and getting an increased understanding of. But it really falls back into, oh, my light's just gone out. I haven't been moving enough. It really falls back into sort of ESG assessment of things. And so taking that full life cycle view of the mining sector. And I think one of the things that we've seen really come to the fore in the past couple of years has been that ESG assessment around transactions. And whilst ESG has always been important, it's really, at the forefront of decisions. And when it comes to a risk assessment, it's expanding out that risk assessment now to look at things including climate change risks when evaluating a transaction. And because we are looking out over a number of years, so including that as part of what we're looking at. to make sure that we are actually thinking, through not just the cycle, but through some of those longer term impacts around what we're seeing. So I think that's been part of what we've looked at, and really it's the culmination of those things which led to us looking at things of moving downstream into the EV battery facilities, looking at recycling and its role in the metals market, and that we'll increasingly see that as companies are looking to reduce emissions. People are talking about scope 3 emissions, having targets around carbon neutrality. And really that's, mining companies now looking downstream of where does their product go, and having more awareness around that and evolving strategies around that. And I think that really pulls back into that circular economy and how we'll see that evolving for our client base, and then what kind of financing solutions we can put together around that.
Now, Karina, I just want to touch on something a little bit different, and that is the almighty potential power in the superannuation industry in Australia. Now, I think there's something like $2.9 trillion in assets sitting in our collective superannuation accounts. A little over 30% of that is sitting on cash, a little 50% of that is sitting in international shares. But what I want to know is, given that in this low interest rate environment, is there any room for Australia's superannuation industry to move into the mining and metals sector and aid its growth? Can it provide benefit to both the mining sector and to our super funds?
You're spot on, Shae. The Australian super industry is in the box seat when it comes to investing in these mines and their processing associated technologies. As I mentioned earlier, the capital requirements for these plants are high, in the order of $500 million to $1 billion, and in the case of some, $2 billion. They can take up to 4 years to get payback on their invested capital. And so that capital hurdle traditionally for the mining industry has been really hard to overcome. In recent years, the mining industry has been able to access government-funded organisations like NAIF or the Clean Energy Fund, and they have lower costs of capital, lower return hurdles and longer amortisation schedules. So if the super industry is willing to be a bit more patient, aim for a slightly lower capital return, we could see some very long life mines with their associated infrastructure and plant being built across the country. That creates highly skilled jobs, not only in the construction phase, which of course is temporary, but in the ongoing running of those plants. This will ultimately leads to an increase in the sophistication of Australia's overall advanced manufacturing sector. And at Acorn Capital, one of our core focuses is to provide our super clients with access to companies which are involved in exactly these types of projects. We're particularly interested in innovation and employment growth, and those are two key UN Sustainability Development Goal outcomes that are aiming to have progress by 2030.
Now, we're nearly running out of time today, so I just want to come back to you, Sophie. And what I didn't get to ask you before is touch on exploration. Now, obviously, exploration is a gamble. You don't know what's in the ground until you go pull it out of the ground. But this sort of circles back to the question that I asked Jackie, is how important when it comes to your analysis and your work is obviously the hot price for the commodity versus the potential of what a junior might find when they're going to get it out of the ground.
Yeah, thanks, Shae. So in terms of, exploration and how that ties in, certainly it does take a long time. And I think that's something that we all sometimes forget, is how grueling a process it is to go out there and explore, find a definitive target, and then further explore on that. I think when it comes to commodities, what we're finding now is certainly the interest is still around those EV metals, like we have talked around so much in today's panel in regards to, nickel, copper, lithium. Nickel is certainly a metal of choice, given that the supply doesn't look like it's coming on as aggressively as what it needs to be, as we've discussed today. And so you do have exploration companies partnering with the large miners and going into jurisdictions that the miners sometimes just simply don't want to be in or can't be in, for a better wonderful word. And you are seeing these junior explorers taking these very early stage targets into advanced exploration. So certainly the miners, the big major miners, can't do all the exploration themselves, but there's certainly a thirst to improve their resources in those commodities, especially those clean metals, as we've spoken about. And in order to do that, you know, we are seeing more and more partnerships with junior exploration companies.
All right, everyone. Well, I believe we've got time for a couple more questions before I get the flashy red light to tell me it's all over. Karina and Jackie, I'm going to aim this question at you, seeing as you're both in private equity. Now, we'll start with Jackie. Jackie, what does private equity offer investors over retail investing?
The investors, so the people investing in our fund. So the biggest thing the private equity offers is uncorrelated returns to the general market. So we are looking for particular investments. At times we're not hitting benchmarks and investing in the major investment within those big funds. So you know, that's the key bit, is uncorrelated returns. The other is we're active investors, and it's really what we give the portfolio companies we invest in. Deb touched on ESG being, you know, such a big focus of late, and you know, it used to be the fact that you could go to, you know, alternative sources of finance if you couldn't meet the ESG requirements of your traditional banks or other forms. That is not the case anymore. All sources of finance, and particularly our investors that come into our funds, demand high level of ESG focus and compliance. And part of what we provide to those companies when we're on their register is the expertise and advice that typically a junior company does not have the resources or just simply the experience and knowledge of where to go to get it. And so there is that extra layer of value add that we provide to the companies, which our investors in our fund get the benefit of.
Karina, over to you. Do you feel, oh, sorry, you continue.
Thanks. I'd say Jackie's absolutely right. It's the return profile that we can offer that's in advance of any particular benchmark or ETF. In particular for our retail investors, Acorn Capital provides access to deals that they may not get opportunity to participate in through primary market deals, and also through our unlisted investments as well. And to reiterate what Jackie's mentioned, we do work with our companies, particularly around ESG and sustainability development goals, and also in governance in particular. That's a core area we work with our businesses on. We facilitate them improving those areas. We give them feedback, and we also work with them to get their companies onto particular platforms. As you'd be aware, there's any range of sort of ESG platforms, whether it's Sustainalytics or sustainable platforms or others, who are looking to rank companies. And part of what we do is work with them to ensure they do get on those platforms. Obviously, as Deb has also mentioned, that's becoming a bigger and bigger focus, and it is a focus for our clients as well. I mean, it's one of the things they're actually asking us to do. Once upon a time, we were not given particular exclusions in our mandates around what kind of industry we could invest in, but now we have some very particular exclusions that we are not allowed to invest in, and I suspect over time we're going to see that grow more and more, and that therefore dictates where the bulk of the money is going. And as Deb's mentioned previously, these green funds are really growing in size, and therefore the weight of that capital is really going to start to drive decision making, and ultimately investment goes into those areas. That's where the success of the businesses are going to be in the future.
All right, thank you very much for that. Deborah and Sophie, I'm going to throw one more question to both of you. Now, Deborah, you did touch on this a little bit, but I just wanted to find out, has COVID disrupted completely how we assess companies for investment, or is it really just a short-term blip in the scheme of things?
Well, as to whether or not it ends up being a short-term blip remains to be seen. But I think that it is about sort of maintaining the focus around fundamentals and technical assessment. And, you know, for institutions such as ourselves, where we do pride ourselves on being technically focused and industry focused, having that real understanding of those underlying fundamentals, getting into the details around an asset, technically understanding it, making sure that we are structuring things appropriately, that we are looking through price cycles. So similar to some of what Jackie was touching on in terms of, wanting to make sure that you've got assets that are going to be able to, perform under different price scenarios. We're obviously not looking for an equity return, but we are certainly looking for our debt to be repaid. And so you want to have that wherewithal in different price environments. I think part of the challenge is, of course, we can never know which price environment are we really in at any point in time. Are we at the bottom of the lithium cycle? Is sort of the outlook for nickel up from here? All we can really do is make sure that we are banking the best assets that are the most well positioned. So those that are in the first and second quartiles of the cost curve. Once things are starting to move into the third quartile, what kind of resilience is there in a downside scenario? Just to make sure that you do have an appropriate financing structure. So come what may on a price cycle, whether it is, impacts from a global pandemic and what that might mean in terms of demand for metals. Obviously, we're seeing, a lot of response from governments with stimulus, which should underpin demand for metals. But likewise, we're seeing, areas of Europe that are in lockdown, and there'll clearly be economic consequences there. So we can't control those things. All we can do is make sure that we're doing all of the due diligence to best understand those assets and how they will perform over a cycle and take that longer term view.
And Sophie, over to you.
Yeah, look, I think from an equities perspective, certainly you need to be very mindful of both the short term and the long term. In the short term, it's all around being aware of fund flows, rotations in and out of commodities and earnings momentum. Today, given that we've seen now the announcement of the Pfizer vaccine, and no doubt we'll see more announcements going forward of other vaccines, it's very much a commodity-led performance. We've seen a rotation out of gold and into copper, and we'll likely see that rotation start gathering momentum over the next couple of weeks, given the leverage to copper to that global recovery, thematic. Long-term, long-term prices certainly underpin valuations, and DCF is so critical when you're looking at mining companies, because that's what supports your longer-term view on the equities. But we do deviate from fundamentals when these short-term drivers are so meaningful, and that's what's happening at the moment. Is we are getting a lot of strong earnings momentum. Earnings upgrades are going to be coming through, and that's what people are chasing, not necessarily those fundamental stories. It's absolutely on a long term very important to invest in quality management teams, quality assets, and as we've been talking about, those assets that are resilient and have low costs. But right now in the market, what we are seeing is very big rotations coming through, and I think that we'll see rotations not only amongst the commodities but also through the different sectors, and that's why we're seeing quite violent trading days at the moment.
All right, thank you very much. Now, unfortunately, everyone, our time has drawn to a close. I would like to thank you first and foremost for joining me. We have managed to pack an awful lot into our time. So thank you, Jackie, Sophie, Deborah, and Karina. It has been a very informative, I believe, all-star investment panel. So thank you.
Thanks, Shae.
Thanks, Shae.